everyone. Welcome back. Nice to be here. Mike Fairboy sitting in for James Boyd for the growth and value investing class. Nice to have you all with us. Hey, today I wanted to look at building a fundamental case by just using a point system around growth prospects. In fact, what is growing, let's say, for example, in a major market index like the S&P 500? What does that growth look like over a period of time? Are we seeing growth across a number of different indicators? So we'll use kind of a numeric way to kind of try to understand, is there growth or not? Are we getting 4 out of 4 of these sort of criteria, which we'll go through here in just a bit. But yeah, look forward to it very much. And welcome to all of you. Familiar names in this class for sure. We've got Riceberg, Jay Richardson, Will, Lola, Scott, Life in the Fast Lane. We've got Grace, David, Sri. Great to have you on board. JB is welcoming his son back from a mission. So he left to the airport. And so I decided to fill in for him, even though I do have a back-to-back class right after this class, markets and sectors, but we're ready to rock on that as well. We'll jump into that after this class and get started there. By the way, we are joined by a good friend of mine and colleague, Cameron May. Great to have Cam on board with us here. Folks, you can follow us both on X, Cameron May CS, Mike Fairboy CS. Cam's got a lot of great material out there. I'm sure you're very well aware of that. Some advanced some advanced technical analysis classes that are really great too. But with that, let's get the show on the road. All right, so starting with some disclosures here first. Information here is for general information purposes only and should not be considered an individualized recommendation. Now, paper money software applications for education purposes only. There are risks associated with investing in dividend-paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends. Now, that's an important point because we will be looking at some of these companies in the S&P or the NASDAQ, and I'll just kind of show you a few of these here as we go through them. But yeah, they will be paying dividends. Now, investing in stocks does involve risk, including loss of principal. Past performance is no guarantee of future results, and there is no guarantee that execution of a stop order will be at or near the stop price. Well, with that, I'm just going to dive right on in to the S&P 500 index here. I want to take a look, just broadly speaking, where we're at. Oftentimes, we will kind of get a little bit of seasonality this time of year, which does tend to get us into a choppy range come August a lot of times. We might go sideways. That's not in every case, but on average, you'll tend to see that. Kind of had a pullback right off the top part of July, but notice down here that there might be some support. Oh, you're not going to see black too well against a black screen, but you'll see down here there may in fact be some support points that we could find on the S&P 500. Just really, really big picture. So I wanted to kind of highlight that as we looked at this right now. But we're going to be looking at stocks specifically in the S&P 500, but those tied into growth specifically. I want to actually share this with you as well. You know, the S&P does actually have a grouping of stocks, and let me just pull those up right now. They'll categorize some into growth and some into value just on different sort of criteria that they're using. We're going to kind of do something today. We're really going to be looking at this area up top here, growth, and really what is the strongest growth over a year-to-year time frame, which is a way that many analysts and institutions will look at growth. So they're looking at the year over year, so year into the next year, growth, right? And they look at that oftentimes just as a percent. So I've got a number of different fundamental criteria that I want to look at so that we can put a checklist on here and check off and say, okay, on the criteria that we've got, there are over 4 different key categories, we're getting a 4 out of 4 reading. In other words, we're seeing growth in all of these categories. Now, why would that be helpful? Well, as we look at this chart of the S&P 500 growth, you can actually see the symbol they use right there, $ SP 500 PG. The value is just PV for value. But folks, it's very, very difficult, especially over extended periods of time. And I think many of you know this, and I know JB talks about this, at length as well. But when you're looking at a growth stock, and let's just pull something up. Here's Meta that has been growing. We saw an earnings announcement that gapped above a prior high over here. To get growth, I'm just going to zoom out to a 5-year time frame. All the way here, you can see that was 72 about 5 years ago. And now we're in not 72, but 772. Uh, Big growth. Now, can any of us imagine that we would see this kind of growth in Meta if it was just all on expectations of just growth? In other words, or let's say reductions in growth, right? We're seeing a fair number of fundamental ratios, percentages that is, that are actually on the increase over a period of time. And by the way, I mean, we're obviously we could talk about revenues, earnings, key driver, cash flows, but other criteria as well can keep these companies going up. You don't see charts like this, or really from 2023. You don't see charts like this if you're not seeing growth behind the scenes. Remember, there's a company behind every stock. I was trying to remind myself of that. And so I think it's very, very important. What can that do? What can that do for us? It can help fundamental growth, right? It can help. This is why institutions are, by and large, they look at a lot of fundamentals, but it can help to kind of put sort of a structure behind the trend. If we were just looking at the growth of earnings per share, for example, or cash flow, it's probably very likely going up over a period of time as well, right? Retained earnings, one big key word that Warren Buffett loves to state. But notice if your earnings are going up or your fundamentals in general, could that also give structure to a chart? Could it give us a higher degree of certainty or expectation? It's probably a better word, a higher degree of an expectation that, let's say, maybe we're looking at a flag pattern here. Will this flag pattern break out and run off of prior highs? Well, maybe if earnings and other fundamental factors are going well, it sure could. So that's what we really want to tap into today as we dive into this. Okay. So let's do this. We're going to start over here and get going on a couple of different items. In fact, what I want to do first is just kind of highlight over here, and I'm going to kind of narrow these guys down. I am going to pull up our scratch pad. I'm going to have to there's some other criteria that I had previously. I'm just going to knock these guys down. And we're going to start up here, and we're just going to type up some different categories that we want to be looking at. In fact, I want to look at a point system, first of all. And in this case, we're looking at 1 point per each growth metric year over year. Like I said, it's a hot topic for a lot of institutions. They'd like to see that growth, but different categories we want to look at first. I'm going to just kind of highlight each one of these, just underline it, it's fine. And we'll click back on it here. And we'll say the first one is, we'll just go all caps, profitability. Okay. And with that, I swear I clicked on that. There we go. We'll click on it again. Profitability. What factor I wanted to look at today was going to be growth profit margins. Now I've got to get all this off. There we go. Okay, so let's do this. Let's go gross. Boy, oh boy. There we go. Gross. We'll get it. We'll get it. There we go. It was going to come eventually. Gross profit margin. So what is gross profit margin all about? Well, we're looking at the company's margins on a gross scale. What are we getting in terms of revenues versus, so the sales numbers, the revenues that are coming in, what percent of that are we getting relative to certain costs that are associated with the business, direct costs, as they like to say, okay, to create the revenue in the first place. Is that number going higher? Are we able to keep more relative to our costs? Are they becoming a little bit more streamlined, a little bit more efficient? That's what we're looking at here. And I am looking at increasing. I want to see this increasing from prior year. We're just looking at it like that, from the prior year. That's our first category right there. We can do all of this fundamental screening, which is so great. We can do it right in the Thinkorswim platform here. And all I'm going to be utilizing here is up top in the scan tab and then the stock hacker. So these are going to be 4 fundamental type criteria. Let's go through those right now. I'm going to add the first one in, and that's going to be that gross profit margin. We want to see how that's doing. That's really kind of a hot topic for a lot of institutions and researchers, fundamental researchers, because if your profit margins, gross profit margins are going up, more of that money can fall back down to earnings and support earnings per share, is what a lot of that could be. All right. So over here under fundamentals, you can see the default is book value. We're going to go right down here into gross profit margin. There it is. The beauty of this is we can go down here under this current and we can just say year over year percent. That's perfect because that's exactly what we're looking for here. Increasing from the prior year. And all we're going to say here is at least a minimum. We can raise these numbers up as much as we want as well. In fact, I wanted to try to do that with the NASDAQ, which is more of a growth type index. But in this case, let's just say it's increasing at least a minimum of 1%. No maximum over here. So really the sky's the limit. You're going to get some of those that may be increased 5, 10%. That's a big jump in gross profit margins, but we're leaving that open for that kind of growth over here on this side, okay? So let's go back now. Let's hit our next category. We want to look at the company's effectiveness, how they're working with their existing assets. In other words, we have total assets that a company has. And remember, assets are those things that a company owns. They own the equipment, right? For example, they own the equipment that's capital equipment. And that capital equipment, as it is being put to work, is generating net income. This ratio is simply just net income divided by total assets. And that's what's going to give us an effectiveness ratio here, or an effectiveness category. How effective this company is being. Okay. Okay. You got to click. Dots showing up, but I'm going to have to get rid of those dots eventually. Let's do this. Effectiveness. Click, click. There we go. Nope, still not doing it. Now it should do it. Nope. So just when I click on underline, it doesn't. Anyhow, that's okay. We don't need to underline it. We'll just do this. Caps are probably good enough. Effectiveness. Effectiveness, okay? How effective is the company at generating that net income from their own asset class? All right, so to do that, what we're going to do next is we are going to look at, oh, there it is, simply just the return on assets. Okay, and that's also known, folks, as ROA. Okay, that's ROA. We're going to be doing the exact same thing we did up here. I'm just going to copy this, simply just copy this over and type it in. That is ROA, though. That's okay. You guys get the sense. It's ROA. Let's make sure everything fits on the line. And it does. That's okay. We'll put it in. ROA. No, it doesn't. Return on assets. Okay, net income divided by that particular number. All right, by the total assets. Okay, so let's go over here now, and we'll take another look at it. Now, right, we want to see how they're doing with their existing assets because we can get growth into a company from two sides. Okay, as I highlight this just quickly, I wanted to show. Not there. Take this off. I do like that blank screen. It's just such an easy way. Truly a blackboard here. Beautiful to draw on. Okay, so first things first, how do we get growth into a business? Think about it this way, folks. This can be one way to think about it. You've got a new income coming in, right? That can grow a company's business. From the income statement, we see that. But we also have existing assets, liabilities on the balance sheet. I got to highlight these or abbreviate them for short. It's just a long statement to write out there. Income statement, balance sheet. We can get growth on both fronts. We've got revenue over here. If revenue's increasing, that can grow the business, right? We can grow it bigger. But also, what about our assets over here? If our existing business that we already own, right? We talked about assets of what we own, assets. If it goes higher here, well, could we not get growth from two sides of the business? Short answer is we can. And that's what companies will look for. We'll put that chart back up. But let's go ahead and go back into our scan and add that next fundamental filter in. Here we go, fundamentals. We'll dive on down into it and into towards the bottom here. Return on assets, beautiful. There it is. Return on assets, folks. All it is again, right now, remember clicking on the drop down, second drop down under current, year over year, and we're going to do a 1%. There you go. Okay, we've got that one now. So at least that will leave the maximum open. All right, let's continue. Next one we've got, because we're continuing on here, we're looking at now just straight financial strength. How does their financial condition look? How does their cash situation look relative, their cash relative to their liabilities on a short-term basis? So short-term assets versus short-term liabilities, how is that functioning? Well, we can call this financial strength. And I've got actually two categories in here. I'll just put them both in right now. Strength. Okay, and the first one is going to be, you guys might have heard of this before. It's one that, Warren Buffett has written about a few times, I know, and now we're getting into kind of financial strength, big picture that he likes to look at. The current ratio, that is, and that current ratio just simply looks at current assets divided by current liabilities, and we're just getting a general sense of, what does that relationship look like? And Warren Buffett says he wants at least two or better. He wants, those short-term assets. In other words, a lot of that is cash, or it's really assets available within a 1-year time frame relative to expenses, you could say, those liabilities that are due within a 1-year time frame. He wants twice as much assets to pay off those liabilities, 2-to-1 ratio. And all we're looking over here is the exact same thing we had previously, increasing from prior year. All right. Let's get one more while we're in here, though. We'll put it right below it. The next one is how is the company doing in terms of its long-term debt? And we do have it's actually, the way that Thinkorswim does it, it's to capital. So it looks at what's owed relative to what's owed relative to what's owned in terms of like capital. Well, we're just looking at it. What is owed? What is owed? A lot of times companies that are improving well, what happens is those debt figures can drop. One sign of a company that's been growing well, one of them could be, is they don't have any debt. They just don't have any debt. They've just had so much cash coming in. They're like, well, all we got what are we going to do with all this cash? Well, I guess we could pay some debt off. It's a really interesting sign of a company doing better, too. Okay, and I'm just going to say debt to capital, because sometimes we'll just look at long-term debt. In this case, Thinkorswim looks at what's available on the platform is long-term debt to capital. Again, this is just increase. Oh, shoot. It's not increasing. This is the only one that's decreasing. Decreasing from 1 year to the next. We want to see that number dipping, and we can do that over here too, right off the platform, very quickly. Let's do it. We've got two more to add in here, and then I'll see if we have any questions on that. Here is your current ratio. So it's really nice. It's right there. There's a year-over-year increase. We're going to go ahead with just a 1% as well, because that's what we're looking at. That's our scan, is a year-over-year 1% annual. Last but not least is the one that we want to see declining. Now that does require us to change things up a little bit down towards the bottom. There it is, long-term debt to capital. There it is, long-term debt to capital. Now, in this case, we're still looking at a year-over-year percent change, but it's not a minimum, it's a maximum. Okay, so we want this to decrease by 1%. And of course, these can be changed, and these debt figures could drop substantially more if we wanted to as well. We could have that drop. But you guys, that is what we've got over here. Okay, does that make, we looking good there? We'll erase a few things here and here. Oh, that doesn't want to erase, that's okay. So we've got a few different points, and each and every one of these categories is going to have a point associated with it. Now I'm scanning for all of them, but we could just say a point value of a +1 over here, if it has it, right? +1, +1, +1. The way we've set this up now is that everything here has to show up. So just to let you know, you're getting broad categories here and each of them has a point. Now, one thing that we could state, these are like common factors or different criteria that, institutions might use, but they'll also say, you know what about a 3 out of 4? 3 out, let's type it out here. 3 out of 4 criteria met. So this gives us a point system. So in other words, believe me, if we were to just like knock out one of these and just take out that one, we're going to get more numbers than we're going to get. I mean, more hits in terms of more stocks showing up than we otherwise would, right? And you could do something like this if there were other criteria you wanted to add. But it's a way to kind of organize fundamental companies so you have a really good idea that they're meeting 3 different categories, but 4 different criteria or anything else you've added or subtracted from it. And then in addition to that, you know that it's meeting those categories, and then how did the technicals kind of look? So the last thing we have to do right now is just hit the scan. Before I do that, let me just take a quick peek down here and see how we're doing. All right. You guys feeling all right? Not as interactive in the chat as it is with JB. Sorry, but this kind of a presentation, it's just a lot of data driven, but it's really nice because once you have it, and by the way, we can save this. Does anybody want this? If you do, I can save it and put it into the chat. Just let me know. Okay, yeah, and by the way, to the point, Paul, let's see. So any of the scan and check against return, exactly, Paul. And that brings up a key point here, is this right over here. What are we scanning in? Do we want a list of companies that may be a little bit more established out there, perhaps? Maybe they've been around a little bit longer. Maybe they have a history of profitability. What are we seeking? Right now, we're just going to use the S&P 500 to help us maybe with some of that, perhaps. So there you go. We'll seek in that group. Maybe go ahead and click scan right now. We'll see how many companies we get. We get 41 companies out of 500. I think there's 500 in the S&P right now. Sometimes it varies, but what is that percentage? Yeah, less than 10% of the companies, close to 8% approximately of the companies in the S&P 500 meet all 4 of these criteria. So 1 point, 1 point, 1 point, and 1 point. Now, the cool thing about this too, if you want to see what those numbers are, of course, you can add them down below. You can add the categories. Let me just pull this, make it a little bit bigger for us to see here. Okay, you can add these, and I've just put in a couple here just so you can see how this would work from 2024 to 2023 so that you have the data right there at your fingertips. And all I'm going to do is just simply say, hey, did any of these decline? I'm just going to choose a company over here. Any old company will do. Well, anything, they all fit. Kellanova, AKA, or used to be Kellogg's. How did they do from 2023 to 2024 in terms of their long-term debt? Did they make any progress on it? 56, that's the ratio of long-term debt to capital. It's fine. We can measure it that way. No problem at all. Look over here, folks. Boom, right there. It dipped. Nice, right? Looks like it's more than 1%, but it's got to be at least 1%. Some of these companies did a nice dip. This one over here, Netflix. Oh, we've heard of those guys. I just wondering what it is. What had a big dip, but look at their decline. Some of this can be fundamental growth of the business because they have money to pay that off. Oh, it just jumped on me. Dang. 43 though, that bugger. Okay, here we go. It went from 43 to 36.9. Okay, so you can see the decline there. All else equal, folks, that is a positive. They've reduced their debt. Let's go ahead and share that right now. I saw a few yeses. Okay, everybody came out. There we go. So let's just share that right now. In fact, I have to save it first. Or can I think I can just do this. I don't think I need to save it. Yeah, that should do it, right? Cool. All right. Let me just plug this in here into the chat, and there you go. There you have it. There is this scan. If somebody could run it, though, just to verify you're getting this, that would be great. Just like to make sure on these demo accounts that you guys are getting it, working on your end, and we're good to go. Okay, so look what we've been able to do here already today. We've been able to screen through the entire S&P 500, having categories of profitability, sort of external growth, effectiveness, internal growth, And then how are those companies' ratios looking? Financial strength, long-term debt to capital. Remember, that was the only one that's decreasing. Now, if you got the scan, you guys are good. You're all set because it's got everything lined up over here. But if you're building it yourself or you're thinking about anything else you want to add to this, right over there on the right-hand side, yeah, you're going to have that max end right there. And you want to make sure that anything that you want to decrease is going to be over here. You want to actually put a negative sign in front of it so you get exactly what we got over here. But it's beautiful. Everything does set up. I'm just looking at Allstate up here too. We can look at, let's pull up one more in here and just verify. Let's say, for example, the gross profit margins. I'm going to kind of shrink these guys a little bit. There we go. We'll get this over here. We've got room for plenty more. Here we go. So here's the gross profit margin. I'm going to double click and double click so you guys can see how I did this over here too. Let's move these guys up to the top or right after description is fine, or industry or whatever. Yeah. Okay, fine. We'll line these all up together. But what you want to do to set up the different years so that you can make that comparison from the prior year to this year. And I think we don't have any of the data yet, completed for 2025. So we're still using 2024, and that's fine. But the top one here, maybe we say, I'm going to flip it around a little bit because I think many of you might like to read it the other way. How about from the furthest year out, 2 years ago, okay, into this year. So you'll see what I did there. I changed it because sometimes people don't want to see 2024 and then look at 2023. In fact, they like to see 23. They like to see 23, year 23, and then 24. I like to read left to right. That's my preference. Some of you guys love to read right to left, but whatever you want, it's right there for you. That's the beauty of this whole guy. And let's click on it again. Boom, right there. Okay. Paul, thank you, David. Thank you, Paul. Thank you, David. Thank you, Jay Richardson. It works great. Excellent. Good to hear. And it could be just a baseline for you guys to work with. Of course, you can add other details in, but that point system is effective just to mentally think through sometimes. When you're looking at all this data, you say, well, what do I have? Gosh, I have a point system. So that's where the scan's really helpful. You guys know how you're assigning points. Okay, quickly, let's go over here, though. Let's take a look at this and just confirm that everything's set over here. And we should see growth from one or the other, and boy, do we. And it's beautiful. Like I said, folks, we just put a minimum of 1% on all these. And it is beautiful to see that kind of growth. What's growing over here? Well, Allstate grew. Look at their gross margins. 13 to 23, like over 10%, looks like. Very close to 10, but over 10 for sure. Now, this is kind of fun too. Electronic Arts made the list. What's nice is everything on here made the list, so we're dealing with 4 out of 4. But look at those margins. You get to see those margins too, visually see them. That's another cool benefit right here in Thinkorswim. But I've loved this. The data, I've gone back and I've looked at the data, and I really love, to see that clean data come in, which I'm saying, I can't tell you the last time I saw bad data. So we're seeing good data. There's NVIDIA as well. 72 to 70, almost 75 right there. All interesting positives. Like I said, only 8% of the S&P gets this. So if we're looking at core fundamentals first and then technicals, well, we have an approach that we can use for sure. It's right here at our fingertips. In fact, what else do we have in here? Baker Hughes. Let's look at this chart. That's a big, oh, yeah. Hey, that's not gross profit to gross profit. That's gross profit to net long-term debt. I got to scoot over here. I got a little excited. Now I totally lost my place. There we go. Oh, see, a lot lower. About less than 1%. But see, well, I'm sorry. It's more than 1%, but it went from 20 to 21 is what I'm getting at. These are moving around, but it's fascinating just to see what's in here that might have some strength behind the scenes. Or how does JB say it? Under the trunk? Wait, under the hood. Wouldn't be under the trunk, would it? Be under the hood. Yeah, that's what's potentially driving the stock. These fundamentals, a core factor. Let's look at that BKR. BKR. Don't want a weekly chart. How about just a BKR over here? Oh, Okay, so it had recently beat earnings. It might be having growth. We looked at internally and externally, some fundamental ratios to help us do that. Okay, how's this guy doing over a weekly pattern? Oh, it's kind of about a trend going up over a period of time. Just an interesting thing to keep an eye on too, so you can kind of plan out and see maybe next, hey, is there a flag pattern? Is there a bull flag pattern? Things along these lines that could be effective to use for you, for example. Okay, and so let's do this. I want to go ahead and just make a quick variation here. We're going to go to the scan, and I'm going to do just a huge change. I'm going to go over here, and it's so easy to do, but instead what I want to do is look at the NASDAQ 100. So really kind of growth. What's interesting here on the S&P, by the way, these companies, I haven't hit scan again, you might be getting growth and value combinations. There could be some in here that they could just be seeing some real growth in here. So even a PE ratio, or a way to verify the PE ratio, once you've got that established growth, could be another way to kind of check this out too, right? That could be something else that could be looked at. But what I want to do here is I'm going to make an even tighter search. I really want to see what's growing out there. And I'm going to say, we can leave the debt levels the same, the current ratio, but let's just kind of what I would refer to as making the search a little bit tighter, make it a little bit more challenging, you could say, to meet the list criteria. So let's just see what we've got in terms of a 5 here. Ooh, we're gonna get anything? A 5 and a 3. So a big increase. You know what? We'll just go 5 and 5. Why not? We got nothing to lose, right? Okay, so a 5 and 5. So gross profit margin, a serious increase here. ROA, a really good sized increase as well. Let's hit that scan and see what we've got. Wow, that's really quite low. Now, AMD didn't do too well today. I don't know if you caught the news. There was some news about maybe I think the purchases from China not being as high. So I don't know if that's like a great example here, but some others we could look at. But things can change. We're looking at historical numbers, but a lot of times that's what can keep that longer term trend up. There's Netflix. It's kind of a long, extended move, right? Don't know what people might be looking at there, but I mean, there could be, it's certainly the trend's up on it. And there's CEG, Constellation Energy, which actually broke above some prior highs over here as well. And that could be interesting. Now, a lot of these companies that I look at here, I talk about, in my swing trading class, because sometimes there are fundamentals that are operating behind the scenes as we look for some of these sort of flag patterns. If that's sort of something that resonates with you guys and you want to tie into it fundamentals as well, that could be an interesting approach to take a look at. Just as a quick note, if you are interested, I do have that swing trade class that we do have on Tuesdays. And here are just a few of the recent classes. We talked about the MACD with swing trades. We talked about using money flow or volume before, but those are just some technical aspects that can be really helpful when you tie it into the fundamentals. I'll just go ahead and shoot that out into the chat as well, just in case you guys want to try to put some of those in. By the way, many of you go to that class, so but if you haven't heard of it or seen it, it's there. Okay. All righty. So on that note, let's continue on. And just state, folks, if you're getting value from this class, smash that like button. That could be of use to you. I'm going to pull this back down. Sorry. Smash that like button. It could, that can, it just lets us know that you're finding these sessions are useful and helpful. And actually I'll just put this down here for swing trading right there. So you got it. There's that link right there. Okay. So, with that, folks, be sure to hit the subscribe button as well. As you go into that, let me just see. I think we're doing pretty good here. Yeah, should we consider net profit margin? You know what? That's an interesting aspect that you could consider as well. Yeah. So we've kind of opened this up so you can go over here too and make some variations. Net profit margin. So as well, I do know that like a lot of times institutions around us, they'll look at like top line growth is really a key element. And this is tapping in to that top line growth when you're looking at that gross profit margin as well. So you're looking at just those costs that are relative to generating that revenue. Heck, you could add that in for sure into one of these other ones. All right, guys. All right, well, I've got the next class coming up, and so I've got a little bit, I've got to do a little bit of prep for that. I didn't have a ton of time to get going on both of these, but hey, the great thing is we got both of these in for you. That was we met kind of what we set out to do. We set up some categories here for criteria, but if you wanted to add one more in here and say, hey, these companies are getting 4 out of 5 or 5 out of 5 criteria that makes sense to you, now you have a way to get that done right off the Thinkorswim platform. So great being with you. Thanks so much, Cam, for your help as always in the chat. If I'm not mistaken, we'll see Cam in the chat for the next class, markets and sectors. So stick around for that if you'd like more information on it. We're looking at some of the more longer term MACD weeklies and monthlies, actually, to give some signs. All right, on that, everybody have a great rest of the day. See you.